Thanks for joining us. I'm Shelly Hagan. I cover the Canadian economy for Bloomberg News based in Ottawa. We have three great economists for our panel today. We have Stéfane Marion, Chief Economist at National Bank of Canada, Beata Caranci, Chief Economist at Toronto Dominion Bank, and Mulraine, Chief Economist at Ontario Teachers Pension Plan. So I'd like to start off with all three of you, if you could give me your outlook for Canadian growth this year and how Canada factors into the rest of global growth in the G7 countries. And Millan, would you like to start?
Yeah, no, thanks a lot. Thanks for having me. I'm really excited about this discussion. I think when I think of the Canadian outlook over the next year, I would set aside the disappointment that we had in Q2 growth and think that things are likely to be fairly constructive in the sense that what happened in Q2 was a blip, and going forward, there are enough tailwinds for Canadian growth that would sustain that strong burst of momentum that we had prior to Q2 well into the next year or so. So fairly constructive environment for the Canadian economy, strong domestic demand, favorable external conditions with strong US and global demand, and commodity prices providing a reasonable boost for overall economic activity. So I wouldn't get into the numbers, but still fairly strong backdrop. My key concern will be inflation. I do think that while Canada will regain the output loss during the downturn over the next quarter or two, it will take some time for us to recoup and get back to the slack that would have been generated. So we wouldn't close the output gap for some time. But even so, there's still likely to be an upwards pickup in inflation over the next few years. And we do think that the inflation is likely to be a bit more persistent. So strong growth, inflation starting to become a bit noisier than it otherwise would have been.
Were you expecting Canada to recover the output loss from the pandemic by the end of this year as well?
Yeah, I think with Canada, we'll be a little bit more delayed. And when we look at the forecast itself, we're expecting about 4.5% for next year and just under 3% the following year. Now, I agree with Millan that we're going to see some good numbers coming through. However, the forecast is highly dependent on our side on two key components. One is that the consumer side carries that growth forward, and the other one is that the inventory rebuild adds substantially to output as we go into next year in particular. And those are the two components that gets Canada, back to where it was and beyond in terms of closing the output gap. Similar to Millan, we think that's a next year story, which is where the Bank of Canada would hike once you start to tighten up your economy and move into an excess demand position, but not before then. In terms of Canada and the global context, I think we're about middle of the pack. The U.S. has been phenomenal in terms of its investment growth. And so the running speed of its economy has not been adjusted downward, meaning potential growth. So we think the U.S. is probably most likely to close their output gap first. Then you'll look to some European economies like Germany and France, and Canada will be in that pack. And then you have others like the UK that will be closing their output gap ahead of Canada, but for all the wrong reasons, that they've had their potential growth marked down because of very poor investment growth related to what's happening, not just with the pandemic, but we're kind of forgetting that they also exited the European Union, and that had substantial investment and trade impacts. So if I were rank order, I'd put US, Canada in the mix with a couple of economies in Europe, and then the UK last.
So, Stéfane, we do have the Bank of Canada expecting the output gap to close the second half of next year. Are you thinking the risks lie more to the upside or downside for that?
Well, that's an interesting question because you can look at the output gap, but at the same time, just to look at Canada's ranking in the world, if you look in nominal terms, we'll be outgrowing the rest of the G7 because, yes, real GDP is not there yet, but nominal GDP is super strong on the back of high commodity prices. So under these circumstances, Shelly, it's very hard from a Bank of Canada standpoint just to know how do you modulate for this surging terms of trade that have been quite beneficial to the economy. So I would think that, it's the script looks like yes, it could close next year, but the labor market gap is not that bad, that large either, Shelly. So I would think that it makes sense right now to think that the output gap would be closed sometime next year, probably middle of the year, but it could very much come sooner depending on how the global economy and the global supply chain evolves.
So if it could close sooner, I know, Beata, you said the U.S. actually looks like it would grow faster than Canada. What does this mean for the Bank of Canada and in terms of its pace of tightening versus the U.S.?
Yeah, so I think, so this is an interesting question, Shelly, because while the U.S. has recovered more of its GDP because Canada had that contraction in the second quarter, which was self-inflicted, right? That was because we were doing lockdowns to contain the virus, and the U.S., just kind of powered through everything. So they've had more continuous growth. The central bank positions have actually been somewhat oppositional, that the Federal Reserve has been far more dovish than I would say the Bank of Canada. So the Bank of Canada has already started to slow down its pace of asset purchases for months now. And the Federal Reserve has yet to even lay out their plan there. And the market speculation is that's going to be a November, December story when that information becomes known. So we think that the Bank of Canada and the Federal Reserve will raise rates around the same time, which for us is towards the fourth quarter. However, it's possible that the Bank of Canada can go ahead of the Federal Reserve for the reasons that Stéfane had mentioned, that the labor market performance in Canada has actually been better than what we've seen in the U.S. We do have, more in terms of nominal price pressures coming through in Canada. And so they're going to have to balance off these factors. And so it's possible that we could see a little bit of a lead on the Bank of Canada relative to the Federal Reserve. But if so, I would say just by a quarter.
Okay, so it doesn't sound like it would be too much of a difference between the two, too much time between then. Millan, what do you think about that timing, and what are your concerns around inflation and how persistent it may be? Because we have heard policymakers globally talking about it transitory, but we've now had 5 straight readings in Canada where inflation's been above 3%.
Yeah, no, I think, Shelly, that's the key question, and that's going to be the central theme around which a policy response will be calibrated by these central banks. My own view is that inflation would be more persistent than central banks are giving it credit for, and they'll probably have a bit more inflation than they need. Therein lie the rub for central banks. They don't want to tighten prematurely because that's the mistake the central banks have made in the past, and for them it becomes a bit more problematic to deal with that kind of disinflationary impulse than to deal with inflation that you can control. But in my view, I think I agree with Beata in the ordering that the Bank of Canada will show a bit more fidelity to its inflation target than the Fed, but I see them as moving more in 2023 than 2022. In as far as we do have them going, it's likely to be gradual. So in a sense, central banks will wait, as some say, until they see the whites of inflation eyes and then start moving. That is, they'll likely stay behind the inflation curve for fear of making that policy error of tightening too soon. But in so doing, it probably will catalyze a bigger rise in inflation, a faster rise in inflation, and so they'll have to catch up on the back end. And the difficulty will be ensuring that they calibrate policy to land that plane well, avoiding that policy error on the other side. So in my view, I think they will wait until later, but they will probably be more aggressive then.
So when do you think the Bank of Canada would first hike versus when you think they should hike?
Have them hiking in 2023, around the mid 2023, have one hike by then, and then the Fed following thereafter. If one were to think from a traditional policy response point of view, with the output gap closing and possibly closing maybe late 2022, early 2023, then you would start lift off just before, given the confidence of that output gap closing, and gradually withdraw stimulus. I do think, because of my view view that they want to go later, want to ensure that the self-sustaining recovery takes shape and that output gap closes, I think they would go on about the time that or after, just after the output gap closes, which gets them to 2023. But Standard Taylor rule or otherwise would have said they would move in 2022, both the Fed and the Bank of Canada.
And Stéfane, what are your predictions and any
think
risk
a lot
around that?
Yeah, because I think it's very difficult to measure, to have certainty about what the potential GDP is and spare capacity, therefore the output gap. So I think it's hard to have more than 55% probability on your baseline forecast currently, and that's true for both for us and for the central bank. So again, it's a baseline scenario, and all depends what probabilities you put on that scenario, Shelly. Because from an inflation standpoint, is it transition or is it temporary, transitory, more structural? I think that, yes, there are elements that suggest it's transitory, the global supply chain. Yes, there's a base effect. But at the same time, we have labor shortages. We have 200,000 people leaving the labor force to retire every year now in Canada. And I think this is just exacerbating some of the pressures that we're seeing. Add to that, Shelly, the impact of carbon taxes that will hit the Canadian economy. So you're talking a potential upside on inflation. So right now, as we speak, inflation is on a 2% trend if you account for the discrepancies caused by the pandemic. But make no mistake, over the past 3 months, headline inflation is running at 4.9% annualized. That's the last 3 months. There's no base effect in that, really. CPI trim running at 4.4% and median CPI running at 3.2%. So we'll need to keep a close eye on that because these are numbers that could surprise the Bank of Canada.
Yeah, certainly we'll have to watch these inflation readings pretty closely. And something that's in the last CPI reading that actually showed a lot of inflation is the housing market and rent prices. What, Beata, do you think is the outlook for the housing market, single-family homes, and then rentals, which we've now seen starting to heat up?
Mm-hmm. Well, Canada continues to suffer from a supply shortage. So we continue to see the demand of house purchases being quite high, especially into the detached market, as the millennials fight it out with the boomer generations on that detached market. And so, this is not something that's going to alleviate in any fast order. Now, we did see out of the platforms from the election under the Liberals and the NDP, as well as the Conservatives, that there was a push towards adding more supply in the market. However, this is not instantaneous. It takes several years, and it requires coordination as well with either provincial or municipal level governments. And so it's not going to alleviate itself in short order. In the meantime, we also saw from that Liberal platform that there are measures in there that are likely going to stoke demand for first-time buyers through things like having, a tax-free account that you can withdraw up to $40,000, rent-to-own measures. These are all good on their surface. But if the demand side is reacting ahead of the supply side, it gives you one direction on where prices are going to go. You actually could run the risk of eroding affordability. So from our perspective, even though sales have come down since about March, relative to that really exuberant buying, they're basically returning to the peak levels that we had prior to the crisis. And the supply side is not showing much movement relative to sales. So we do think that we're going to see a persistent in price pressures, not double digit like we're seeing today because the affordability is just eroding too quickly. But it's hard to build a case that you're going to see any sort of price declines. And certainly the detached market is where the interest predominantly lies. A lot of sales has been happening in the condo market now because of the affordability issue, but the detached market still drives a lot of those outcomes in terms of how the market oscillates between the condo demand and the detached market. When the detached gets too expensive, people switch to condos. It pulls up the price of condos, and then you switch back to detached. So we're in a bit of a cycle there. The only thing that really gets you out of the cycle, as we've seen in the past, are, unfortunately, recessions that cause unemployment rates to rise. And so we don't want to be in that situation, and we're not. So I think we just got to take it as it is and try to get that supply side responding as quickly as possible.
Yeah, it's the resilient Canadian housing market.
Mm-hmm.
Well, Stéfane, I know you've done a lot of research on immigration and looked into this a lot. And that's something that, even though we saw a big drop in immigration, we saw continued strength in the housing market. Now that international travels come back, we're going to be, the government's targeted high immigration rates. What impact do you believe that's going to have on the labor force and the housing market?
It's amazing. Last year, Shelly, we had, to this day, we have great activity in the housing market. But last year was with household formation, according to just published data by StatCan, shows that there was an increase of 27,000 households last year, which was the weakest. It's 87% below the 2019 level. So we had, super red hot activity in the housing market, but we had very little household formation to show against that. So that suggests that there were speculative forces that might have been at play this year. And I would be concerned if that were to remain the case for another year with limited immigration. But fortunately, as of June, we saw a significant rebound in permanent immigration and close to normal, actually above the 5-year average. So it does suggest that we're looking for a rebound in household formation going into the second half of this year and next year. So I would agree with Beata that, yes, activity will normalize, but we're not looking at a collapse if the immigration flows are back on trend in the next few quarters. So not overly concerned about the residential market.
And Millan, what are you thinking will be the housing market outlook?
Yeah, no, I wouldn't depart too much from what Beata and Stéfane have said. I said they both made some excellent points. I do think both from a supply side, that would take, as Beata correctly said, that would take some time for supply to come online to alleviate the pressure. Demand is likely to be solid, not only from an immigration point of view, but from a domestic point of view, with financial condition and mortgage rate still being as low as they are. That will provide, and the economy doing as well as we all anticipate over the next year or two, that would provide a strong source of demand. So demand will continue to be quite strong, at least over the medium term, and it will take some time for supply to pick up, to respond in a meaningful way to alleviate the pressure. So as was said before, the direction of travel for price seem quite obvious from there. It will stay high at the very least, or continue to move higher. So I do think over the next few years, you continue to see strong buoyancy in Canadian housing market and home prices.
And do you think we'll continue to see that strength with the Delta variant that we are seeing globally? It's caused more of a slowdown in the US. How do you think that's going to impact Canada?
Yeah, no, I think that's a great question. We've seen housing activity in the U.S. Take a bit of a hit. I do think that's likely to be temporary. Similarly for Canada, the Delta variant hasn't been as consequential as it has been in the U.S. so far. In Canada, outside of the supply bottlenecks that we've seen that affected growth in Q2, I think it's likely to be less of an impact on Canadian housing. In fact, the fact that our social distancing continued for some time until recently. It's now we're beginning to see the housing market. I think it would be in a month or two that we are going to see that rebound in Canadian housing activity. So I don't think the Delta variant, if anything, would only be probably a blip on Canadian housing activity.
And Stéfane and Beata, what do you think the risk of the Delta variant has on the economic outlook? Have you had to cut any of your forecasts because of it or downgrade them?
Actually, we did for the fourth quarter, and slight impact at the third quarter, just because the Delta variant is impacting the global supply chain. So the products we need is, it's not coming to market, and we saw big declines in productions of autos, for example, in our country. So yes, we've nudged down our growth forecast for the fourth quarter, but for the rest of the outlook, Shelly, we're one of the most vaccinated population in the world, and so far we've navigated the Delta variant relatively smoothly. We have half the cases that we had in the previous 2 waves. So under these circumstances, I don't expect widespread economic shutdowns like the ones we suffered in the 2 previous waves. So I think we're relatively well positioned, and hence our view that we're looking at for a 5-cent appreciation of the Canadian dollar in the coming quarters to reflect that relative outperformance of the Canadian economy if we're right with our forecast.
Yeah, and I would say similar
to, you have to downgrade your outlook?
Yeah, very similar to Stéfane. I think we had to take on board some of the slowing momentum that we were seeing, particularly related to supply side factors. I think there's a lot of demand for autos out there, but there's just none to be had. And so you're seeing that coming through on the consumer profiles in Canada, as well as very strongly in the US as well. So that we took on board. Beyond that, I would say, you know, one of the concerns I have about Canada, and I agree with Stéfane, we do have one of the highest vax rates in the world, is certainly relative to our advanced economy peers. However, Canada has far more sensitivity to shutting down the economy with lower levels of cases and much lower levels of hospitalizations than we've seen in Europe, obviously the US, but Europe in particular, even when we looked at Israel as one of these leader countries and what they were doing. So we haven't built in a shutdown into our forecast. What we have built in is no further progress in reopening. So for the 4th quarter, we do not build in the possibility that, say, Ontario will go to stage 4, because we know that there's a much more cautious stance here when we see a certain level of cases or hospitalizations relative to other countries. And so because of that, there's potentially upside to the forecast should that not turn out to be the case. But if history is any guide, we do expect Canada to show a lot more conservatism here as we go through this fall and winter months, irrespective of the vax rates.
Yes, that is a key difference with Canada and the US, is they don't have the hospital capacity, so they have to shut down. And I know you wrote a piece on vaccine passports and how that could play into economic growth. And it looks like now Ontario and a bunch of provinces have implemented those vaccine passports, so that should be good for growth.
Yeah, that's our hope. Like our view is you got to do everything, use every tool possible to see if you can avoid the shutdowns, especially when you have a lower threshold on hospitalization than other countries. And so we were a proponent of vaccine passports for that reason, in an attempt to protect businesses from having to shut down. We know there's a lot of political and ideological push against these, but from an economic stance, you know, just purely being agnostic on this, we would just prefer that businesses stay open and we use every tool possible. We don't keep resorting to the pre-vaccine tools that we had. We have many more now at our disposal.
And I know we have just a few seconds left, so I just want to ask you guys really quickly, a yes or no, if you believe the Bank of Canada will taper to $1 billion in October at the next meeting. Millan, are you expecting that?
Yes.
Stéfane?
I do, yes.
And Beata?
It's unanimous, yes.
All right. It sounds like that's the consensus. Well, thank you all so much for joining.